Okay, good morning, everybody, and thank you for joining me this morning for a webinar on Monte Carlo analysis of trade returns. You may have thought this was a slightly different title because I sent an email out saying the SPY trade with amazing results, but there was a subtext to that, how to analyze trades using a Monte Carlo style analysis. So we're going to get into that. First of all, what is a Monte Carlo analysis? When it refers to Monte Carlo analysis of trade results, this is generally what is meant. You're trying to generate a statistically significant model of your trade returns or a model of your trading plan by running thousands of trade sequences using a set of observed returns. So for instance, you may have run a backtest or somehow figured out that some trades in your plan were going to make, say a sequence of plus 5%, minus 3%, plus 1%, 10%, etc. through here. But that, when you think about that, that's really only one possible sequence. So if you've done a backtest and you've run it through the whole year, it's laid out for you a sequence of trades for that year. But there's nothing really to say that that sequence is going to be continued. The returns may be valid for the trades because you're looking at signals and you're looking at returns generated from those signals, but the sequence can be completely different. So the question that the Monte Carlo analysis answers is what happens if the sequence that you receive those trades is different. So for instance here, instead of the first trade giving you a plus 5%, what if the first trade gave you plus 10% or a minus percent, minus 10%, etc.? If you reorder them in any way you like, do you still end up with a statistically significant trading system, a good trading system? So the picture over here is just relative equity after you've run one sequence, and on the bottom would be the number of the trade number, so which trade in the sequence, and then relative equity starts at 1. That's the amount that you start with in your account, and then a value of relative equity of 2 would mean 100% gain. So obviously a value of 7 over here would be a 600% gain. You'll see some of these charts as we go forward. So you've sequenced the trades. You've produced one particular sequence, that's great, but then you repeat that many, many times. You do it thousands of times, and you produce a final number for equity and a max drawdown, which is also important with a trading system. And then you plot the cumulative distributions, paying attention to the midpoints and the extremes. So these charts are interesting, and you may know what they mean. We'll see as we go forward how they're produced, but you can read them such that the midpoint here is the average, the mean of the final equities after running thousands and thousands of trade sequences. And the extremes will obviously be the extremes of the results. So for instance, here, if you look at the 0.1 level, this would be 10% of your sequences achieved a 200%, or this is a relative equity of a relative equity. So as I said, 2 would be a 100% gain. So here you can see that roughly 10% of the trade, 10% of the sequences produced a 100% gain. 50% of the sequences, the mean is just under 4, so 300% gain. But if you go way out into the upper reaches, there were some sequences that produced incredible results here. So, in the 90 level, meaning that 10% of the trades produced final equities of around a 6 value. And you normally get this sort of shape, but it's interesting to look at these shapes of final equity distribution. But the same is also done for maximum drawdown. Because if you sequence the trades in a particular way, your drawdowns are going to actually be different. And drawdown is a very important point when you're looking at a trading system. And so the Monte Carlo simulation that you run is based on trading a whole account amount. For instance, if you started off with, 100, the way it's done is you start off with, say, let's say $10,000 in the account, and you choose a fractional amount to trade, a fractional amount of that 10,000 initial equity to trade. So if the first trade made 10%, you started with 10,000. Okay, first trade makes 10%. You've now got 11,000. You then use, if you're looking at fixed fractional trading, a fraction of 1, meaning you're trading the whole amount, you then would use 11,000 going into the second trade. But fixed fractional means that you actually vary that fraction from 0 to 1, and you'll find in the software here it's actually automatically generated for you between 0.1 and 1. So we'll see that going forward. And then you analyze the results to find a suitable fixed fraction for your system and comfort level. You'll see wildly varying results depending on how much of the account you're willing to trade on each trade. Where did this information come from? Well, there's also information on the internet about Monte Carlo analysis, but some of the best information I found is from Howard Bandy of Blue Owl Press. He has written several books, and the one that I've done a lot of reading of and have produced the information we're talking about today in EdgeRater is from the Modeling Trading System Performance book, where he talks about Monte Carlo simulation, position sizing, risk management, and statistics. But he also has other books. Quantitative Technical Analysis is another one. Howard lives in Portland. I've spoken to Howard on the phone several times, and we've emailed a few times too. So I'm quite familiar with Howard's work, and definitely recommend taking these books to have a read and find out more information. If you want just a freebie, there's this link here will take you to an interesting article on his website, which is a post about a particular problem with developing a trading system. And so take a look at this. If you just go to the blueowlpress.com website and look under posts, you'll find this link too. So is there an easy way to do all of that? It sounds like a lot of computations, does it not? Well, guess what? EdgeRater Pro 2020, there is a template for that. And that's what we're going to talk about. Let's take a look. Monte Carlo analysis. Where would you find a Monte Carlo analysis template? In EdgeRater. You would find it in the Pro Tools category, and it is the most recent template to be added. So Monte Carlo Simulation, it's actually called the template. And the template, all it requires to run is a list of trade returns from a backtest. It could be trade returns that you have manually entered, or it could be from running the trade simulation in EdgeRater to produce a set of trade returns based on historical trades in the backtest. So the first thing I'm going to show is a made up set of trades, just to give you an idea of how this all goes together. So the first thing is I have a very simple, I'm going to show you in Excel here. I'm going to open up Excel, and this is going to be the input to my Monte Carlo analysis. And it's basically a trade list, which I've just modified and said there are two trades in here. There's 100% gain and 100% loss. Simple, two trades. And that's going to be the input to this analysis. So first off, I have to choose that file. So I'm just going to go and find it. It's under Trade Simulation Reports. Minus 100 plus 100, I named it. And then after I've chosen the file, I can choose how many trades per simulation run I want to have, and then how many runs I want to do. Like how many sequences do I want to put together to do the analysis. So trades per simulation run, I'm I'm going to set here, in this case, to 5, let's say. So 5 trades per simulation rung, and I'm going to run that 1,001 times. I'm just going to hit the run here. Okay, so very quickly, this is just to show how the template works and how all the information comes together. But the first thing you see is you end up on this Monte Carlo sheet. So what happens here is we choose at random one of those trades for each trade in the sequence. So in this case, it happens to be that the random number chose the 100% gain. So you started off, we're using a fixed fraction of 1 here. Let me zoom this in a bit so it's easier to see. Using a fixed fraction of 1, you started with, in this case, 10,000. So your initial equity was 10,000. Using a fixed fraction of 1, so you're going to bet the whole 10,000 on this one trade. The gain of that trade was 10,000, and so your new equity is now 20,000. Second time you ran, okay, negative 100%. You exposed 20,000. The trade lost 20,000. Your equity is now 0. There is no further trading here because your account is now at 0. So with a system that generates returns like that, if you're using a fixed fraction of 1, you're betting the whole account per trade, you end up at 0 in this particular run of this simulation. But if you select to sell here and press F9, it will actually just rerun and choose different random trades. Okay, and so I will end up with, here's a case where you end up with choosing the 100% trade each time for each of the 5 trades. And obviously that will end up with, this is a very good sequence, that would be the ideal. And this is what the relative equity would look like in that case. So you build it up quite quickly. Now the Pro Edgerator template will run this particular simulation 1,000 times for the fixed fraction of 1. It will then run it 1,000 times for using a fixed fraction of 0.1. And let me just show you what a 0.1 fraction would look like. So I have to allow editing on this template. And I'll say 0.1 fixed fraction. And then we'll press F9 here and run this again. So now you can see if you have a losing trade at the beginning, you've only exposed $1,000 out of your 10,000 because you're using a 0.1 fixed fraction. Your loss is $1,000. You start now for the next trade with 9,000. That's a winner. Okay, and so you have now ended up with 9,900 and so on. So here you get to the 0 level. If you're only looking at a sequence of 5 trades, then you will never get to 0 in this case. But this is running this, remember, this is running this thousands and thousands of times. If you just keep pressing F9, you'll get different choices here. And remember, I'm just using this as an example of how the template works. These are made up numbers. I just want to show there are other worksheets within this analysis spreadsheet. The first one is the results of running fixed fraction 1 1,000 times. On the left, you've got the cumulative number. So there's 1,000 of these. And then to the right, you've got the resulting final equities. These are sorted, so the highest equities achieved from the sequence are towards the bottom of this list. And if you go all the way down to the thousands, let's have a look down here. You'll see it takes a long time before we start to actually get to the trades that had 5 winning sequences in a row. In fact, there's not that many of them. Okay. Let's move on to other of the fixed fractions. So that was fixed fraction of 1. Here, this is what the final equities would look like with a fixed fraction of 0.1. So you're not betting the whole amount per trade. And now your distribution of final equities goes from 0.6, essentially a loss of 40%, up to the mid value here and it's listed up here under FFE50, that's your mid value, is 0.88. So even the average of the final equities are below the starting amount. But there were some trades in the higher reaches that were profitable. And then you can also look at the drawdowns to see what the drawdowns were for the 0.1 level. So we can look at the 0.2 level, 0.3, 0.4. All of these are very similar in the way that they work. But you'll see that the more that you apply to a particular, the more you bet on a trade, the more money you bet on each trade, the higher the right-hand side of the final equity distribution curve is. But the mid-range in this case is, well, in this case, it's actually roughly similar, but it gets to zero pretty quickly on the left. So there's chances with this system when you go up in the fixed fractions of losing the whole amount. And you'll also find that the drawdowns get higher the more of a fraction that you apply to each trade. In this case, the mid value for the drawdown is 75. We're looking at a 0.5 fixed fraction. If we go to 0.6, the mid value is 84% drawdown. If we go to 0.7, the mid value is 92% drawdown. Okay, so it gets, and you'll normally find this with sequences that you try out yourself. So in a nutshell, that's the template. So let's go and look at some actual, how we would actually put together some real trades to run through this. I'll just take a look at some questions. So why are there only 5 rows shown? That's okay. So in the Monte Carlo analysis, you see there's only 5 rows in here because when the template was run, I chose that we're only going to do 5 trades per simulation run. Okay, if you chose to do 100, you could do that, and then you've obviously got a lot more. Well, you've got 100 rows in here because there's 100 trades for this particular sequence. But if you have 100, it's going to be, you're never going to get all 100 to be the 100% gains. I mean, you will if you ran millions and millions of trades sequences. You might end up with 1 or 2. Well, I haven't calculated the probabilities of that, but it would be a lot of trades, sequences you'd have to run to get 100 at the 100% level. So it wasn't really worth showing too many in this example. And yeah, so if we look at, if we just go to the FF1 and you'll see that there are no trades out of the 1,000 that were run, 1,000 sequences, none of them had all 100, as you would expect, all 100 at the 100% level. Okay. All right, let's move on. So, all right, so that's the template. Now, obviously we used a made up set of trades, just plus 100%, minus 100%. What we should do though is run an actual simulation on some real backtested data. So, and this will get to the topic of the email that I sent out. There is a trade in SPY that happens approximately 7 times a year. And then I'll show you what it is. It's very, very simple. We'll come down and we'll just select SPY. That's the only thing we're going to run here. We're going to run against SPY. All right. Come over to the right-hand side and choose your scan. And the scan is below lower Bollinger Band. Okay. At the same default parameters, 20 and 2 for Bollinger Bands. Gonna run this. All right. These are all the cases where SPY was below the lower Bollinger Band. I'm going to come over to the Trade Simulation tab. And in here, I'm going to say, use those entries, go long whenever there's an entry, on the close of that bar where there's an entry, and hold this trade for 22 bars, so approximately 1 month, 22 bars, and then exit on the close of the 22nd bar. And that's all I'm going to do in here. I'm just going to hit run. And these are all the trades over the history that I have. I have in my list 10 years of data. You could go back and put more data into the list, but I only have 10 years of history in my snapshot. And so we're going from 2010 all the way through to 2020. And you'll note that most of these trades are actually winning trades. All right, there are 72 trades, 22 days average hold. Well, that makes sense because we said we're going to hold for 22 days. There is no technical exit other than just a time has passed type of exit. And this has produced a bunch of returns. Okay, so you got 7% return, the first one, which was 8/24/2010, and you've got a 2.69% return. There are some negative returns. If we come down to 2020, there's a big negative return. In February, there was a 20% loss in this particular trading system. Okay, there's a bunch of losers in here, but there's quite a lot of green and a lot of winning trades. And some of the winning trades are quite large. We can sort by size. So the biggest loser was 20%. The biggest winner was 16%, but lots of green in here. Okay, let's take a look at the equity chart. This is the equity chart as the sequence developed in reality, like back tested. This is how it actually, how the sequence actually developed. I'll take off. I'm just going to look at the equity chart. So you can see that does go up. These trades tend to be winning trades. Quite volatile, but they show good results. This is an index, which is basically the indexes always start at 100, and well, this particular index starts at 100, and then it will go from there. And you can tell by the ending value of the index what the average is of this trading system. The index is built by basically averaging the gains or losses and applying that to the prior value of the index. So it's kind of built from the start date going on to the end date. And here you can tell that was a ended up at 240, which would have been a 140% gain in this system if you just used the sequence that occurred. So what I would like to do is take that trade list, and one thing you can do with a trade simulation is click on the pop out button. That brings it up in a new spreadsheet viewer. The reason I want to pop it out is there isn't actually a save button on here to save this trade list on your file system. But once you've popped it out, you end up in the spreadsheet viewer, which has, and this has the trade list in here. And then I can save this as, and I'll pop it into under reports, and I'll call it SPY BLBB 22 bar hold. Okay, and I'll save it. I already have that file in here because I have actually run this before. And I will just overwrite that. Do you want to replace it? Yes, I'll do that. Thank you. So now I've got a real sequence of trades from a historical test. All right, what I've got to do is choose that file. That's going to be my input here. So I'll choose that, SPY BLBB 22 bar hold. And now I'm going to run using a number of trades and number of runs. I'll keep the number of runs at 1,000. But how many trades do you want to have in your sequence? I'm going to choose just around number 50 trades per run and hit run. Okay, so now these are the actual trades over here on the left, but here are the essentially the made up trades. They're taken at random chooses a random number, picks one of these trades, and uses that. And this is just one run, okay, stringing together one sequence of those trades. If I pressed F9 here, it will actually quickly recalculate and choose different trades for this sequence, reorder them, and it will show you the new equity chart for that particular sequence. But I also, this is just useful to do for your own interest to see what the equity charts look like for each sequence. But you're not expected to run that yourself 1,000 times. The program has already pre-run it 1,000 times for each of the fixed fractions. And if we go into the fixed fraction 1, so you're taking your 1,000, or sorry, it should say 10,000 starting equity. It doesn't actually matter here because we're dealing with relative equity, so the actual figures don't matter. When we're talking about relative equity, if the final equity is 1, it means you end up with what you started with. If final equity is 2, you've got twice what you started with. So we go to the fixed fraction 1 tab here. This is having run those sequences 1,000 times using all of the available account for those trades, for each of those trades. And they're now ordered in here. You've got this, what they call inverse CDF, or cumulative distribution function. Okay, and the important numbers, there's lots of important numbers, but some of the numbers to pay attention to would be FE50. This is your final equity at the 50% level. So in this case, final equity at 50% level is roughly 4. If you want to see the exact number, you could scroll down through here until you get to the 50 level and find out exactly what it was. But anyway, from the chart, you can see it's 4. FE50 is 4. Maximum drawdown, the 50% level of maximum drawdown is 20%. All right, so your mean, your average is achieving a 4 final equity and a 20% drawdown. Now, going down to the extremes, these are important things to pay attention to, because you may have a great trading system and you just may end up in one of the sequences that yields a bad result or a very good result. You're not always going to achieve the mean, obviously. So it's very important to know these levels down here. And so this has been called out in the summary, distribution summary up here. FE5 is your 5% level. So 5% of the time, you had a final equity of 2.16 or less. And if you go up to FE95, this is telling you that 5% of the time, you had a final equity of 6.77 or greater. You see how that works. So there were some way out in the some of those runs resulted in great final equities, some resulted in not so great final equities, but the average value is 4 in here. And same with drawdown. So some of the worst drawdowns in the sequences were in the 50% level. Some though were down in the 2% level. Well, you can see here, 1% was the lowest drawdown achieved in any of those sequences. But you never expect to achieve that in your actual trading. The mid value is something to pay attention to. And you'll probably never achieve the mid value either, but it's very good to know the shape of this so you know what you might expect with your trading system. And then this is the fixed fraction 1, which is very aggressive. You trade in a whole account on each trade. So you can then take a look at how this works with some of the other fixed fractions, 10% of the account, the 0.1 level. What does that look like? It gives you a 50 level of 1.15. So it was still okay at the 50 level, but nothing great over 50 trades with a drawdown of 2.1%. So if you read the books, this is where you're going to find out more information about really how to analyze these types of graphs, and read that article too that I pointed out. And this will tell you what to look for, to achieve your comfort level. You may or may not be comfortable with a 50 or 60% drawdown in a trading system, or you may be. It just depends. Everyone's going to have different tolerances. Let's take a look at some of these questions. So Jim, can this be run on, say, the Dow 30 or NAS 100? Yes, I think you probably asked that before I showed. It's really about you produce a trade list using any input list that you have. It can be a pre-canned list like the Dow 30 or the NASDAQ 100, or it could be just a list that you have of your favorite stocks. You run a trade simulation and you produce the returns, and that becomes the input to the Monte Carlo simulation. You also, the example I showed is running the trade simulation in EdgeRater first, doing the backtest in EdgeRater to end up with your list of trade returns. If you have a list of trade returns that you've gotten from somewhere else, maybe they're things you've experienced in the past, or you have another program or another way of getting actual backtested returns, you can just plug them into the Excel spreadsheet like I did at the very beginning in my manual test, and use that as the input to the Monte Carlo simulation. Bruce, what's the largest number of open positions during the test period? Okay, so we go back over to, okay, we're running this particular simulation on SPY only. Okay, so that is a very good point, because obviously when SPY crosses down below the lower Bollinger Band, it could do that again before the 22 days have passed. Okay, so that's going to trigger another entry, provided you have in here in your portfolio rules set up to allow duplicates, which I have. Okay, you could turn that off and so you wouldn't allow the duplicates. That would definitely affect the results, because what is happening here is as the value is getting, as SPY price is dropping, it's coming down through. Let's take a look at some of these charts, by the way, because this will just sort of help explain what we're talking about here. So if I double click on one of these trades in the list, okay, we're actually going to be shown by a handy little yellow annotation marker where the trades were. All right, so we're looking at a chart that's got Bollinger Band on it as an indicator, and what I can see from this chart is that there was an entry here, but if you look at this, you'll note that before this hold period exit occurred, there was another case down here where price of SPY crossed below the lower Bollinger Band. It didn't occur the day after because it was already below the lower Bollinger Band. And I don't know if you can see that on the screen. Is it a bit small? Let's see if I can zoom in a bit. Okay, so the first entry on 10/23/2012 was right here. The day after, this is not classed as a cross below the lower Bollinger Band because the prior day it was already below, so it didn't cross below on the second day. But further on, after approximately, I would say it's 11 or so days, there was another cross below, and that would have occurred on, let's see, that was 11/8, and so you can see in my trade list that 11/8 there was also an entry on 11/8. If I click on that over here, you'll see exactly what I'm talking about. There was that trade, and there was that trade which exited at another time. So your question was very pertinent, and it's how many open trades did you have at one time here? If we go back to the daily equity chart, you'll find at the bottom open positions, And the maximum number of open positions you ever had was 4 over here. So Ghana, this doesn't show time. Show what is the holding period till we reach 50%, or am I completely on the wrong track? Yeah, so the simulation, the Monte Carlo simulation is not showing you time. The actual trading system had a time factor in it. It was holding SPY for 22 bars, but that produced a return number in percentage terms. And the Monte Carlo simulation took those percentages and just sequenced them together in a particular way randomly, and did that many times. So when you're doing a Monte Carlo simulation, to give you an idea of essentially you'd be trying to find out what your annual growth, your CAG, your annual growth would be annualized. In order to do that, you need to have an idea of how frequently the system is trading, and you would have to factor that into your calculation too. So this system trading at there are 7 trades per year on average in this system. Okay, if I've put together a sequence of 50 of those trades, we're looking at 7 years essentially worth of trades. So it would take 7 years to achieve those final equities. So the actual annual growth rate, and CAG would be your compounded annual growth rate, you would have to then calculate based on it being 7 years. But only you know that that's a 7-year sequence based on your input to the program. So Thomas, if you have a percent profit from a series of trades from another trading application, how do you arrange the input file for the analysis? Do you have to have a column header, for example? Okay, what you should do, the easiest way to do that is to just run, for example, what I've just run in this webinar, and save that file, because you're going to then go in and modify the file you've just saved. So here's my file. I'll open it up in Excel. All right. And what I would need to do in here is just change this column to be your column of trade returns. This is the only column that the Monte Carlo analysis looks at, the percent PL. So I would leave everything else the same. You can absolutely delete all of the information that's not being used. Of course, if I do delete that, in this case, that's not going to work because it's calculating the percent based on these columns, but it doesn't need to. You can just copy or type in your own numbers over here. The only important thing is that there is a named range in here. So if I come down to here and select all of this data, you'll see that the named range is called ER_data. So just make sure if you're putting in a list of P&Ls from another trading application and it extends beyond or even less than, if it's a different number than is here, you have to adjust this ER data to encompass that. So how would you do that? All right, well, I'll just show you quickly the kind of steps that are needed here. So what I would do, first of all, is I'm going to copy this and I'm going to paste the values back in so it doesn't have the formulas anymore. All right, so now I can go ahead and delete things so that the calculated columns are not going to be affected. So I can go ahead and delete this information. I'm going to delete all of this information over here. It's just noise that I'm not interested in. Okay, now, for instance, say I've got, let's string together a sequence of trades, this, and we're just going to copy that again. So I've got twice the number of trades that I had over here. So what I will have to do is extend ER data to encompass all that. So what I would do is I'll take my trades. This is the sequence over here. copy that, paste it into this column as values. But now if you look at ER data, and I can look at it just by selecting it over here, you can see it only goes down to this row down here. What I need to do is extend it. So you go into formulas, name manager, you find your ER data name. It's over here. You select this button here. Oops, and that's actually, I've actually got ER data in different worksheets here. So you have to find the ER data that's applicable to this worksheet. So let's just, here, the trade list ER data one. And you can tell because it refers to the trade list worksheet, the scope is trade list. All right, that's the one I want to change. So I click on here to change the range, and I'll just bring it all the way down to encompass my data. All right, and that is what the Monte Carlo analysis uses. It looks for ER underscore data range. It will only use trades that are in that range. And now I'm just proving here that it is actually selected the whole thing. Yeah, so I could now use this as my input. So the only thing you have to be aware of is put your trades in the PL% column, and it looks for that by name, PL%, and extend ER data to include all of the rows of your new data. And if you've got fewer data points, then reduce ER data to only include the rows that you're using. And that's how you do your own list. Ralph, how would you have a long and short strategy? Now we're getting that. Now you're getting into some of the entries and exits points of putting together a trade list in EdgeRater. Okay. So it would be possible to do exactly what we've just said, in that you would run a long trade and you would run a short trade entry, end up with your list of trades, and join them together and put them into that trade list sheet. But you'll notice that in the entries and exits, when you put together a trade simulation, by default, there is no option to have a long and a short strategy here at the same time. That's just not one of the options. So you'd have to run those two things separately to produce two separate trade lists. Could you please pick a strategy and create a backtest data set to run Monte Carlo? Okay, so I think I just did that, right, Philip? SPY hold days or calendar days or trading days. When you put in the hold period down here, fixed hold period, you're talking about a number of bars of holding. You're going back through historical bars, and that refers to a number of bars. Is that close below the Bollinger Band or just cross low of Bollinger Band? Okay, got that. Thanks, Connor. Joel, how is this SP system, the magic system, advertised? Never mind. Okay. Which is about 14% a year. Thank you. Ralph. Yep. Okay, trade a variation on Larry Connor's RSI system on individual stocks and have a history of actual returns. How may your trades should be used? If you have a history of actual returns, that's great, because you can then use the method I showed just now to put them into an Excel spreadsheet, and put them into an Excel spreadsheet, and then you'll be able to run the Monte Carlo analysis on those. John doesn't seem to have the entries or exits tab. Right. You won't if you've done a fresh install of the software, you won't actually see an entries and exits and trade simulation tab. Go to the home menu, go to system settings, and under main application window, choose to show backtesting tabs. That's just an option. You can either have them shown or not. and probably by default that should be changed to be on. But it does confuse some people who don't actually use any of the backtesting features. So to make it simpler, they were just turned off. But go to the home menu and turn them back on. Okay, so we've gotten an idea of how the Monte Carlo analysis works. What I would want to do, this was run just using SPY, okay? And by the way, those results are not terrible, right? Obviously you have to bear in mind that drawdowns would occur. There's the issue of having multiple trades on at one time, essentially averaging down. But in any system that you analyze, you have to know what your inputs are. You can't just look at the numbers and say, that looks great, that looks bad. You have to know what you're looking at and be aware of what the inputs are. What I thought I would show, we've got a bit of time, 10 minutes. And so there's another thing I would like to try. Let's look at the S&P 100. So we'll just choose a smallish list of stocks. And I don't know how many people actually use this, by the way. I'm just going to show one template in here, which I quite like. And that is the, we'll come down to, right, technical analysis of stocks and commodities, the 220 EMA upside breakout system. This template I really like a lot. And you'll find actually if you run this on, let's just show you what this looks like on the CBOE weeklies. This is actually putting together a system based on that article in Stocks and Commodities magazine. And it's a trend trading system. Currently, the biggest winners in this system that are still open trades that have been on for 32 bars and 25 bars respectively, DraftKings and VTIQ. 154% gain in DraftKings. We'll look at a chart over here and go to the very end of the chart. All right, and you can see the bottom area of the chart where you've got the system itself goes to a 1 value, so the trade is entered here, and it's still in this trade. It's holding this trade. So DraftKings picked out very nicely by the 220 upside breakout system. Also VTIQ was able to hold this for currently 128% gain. 100% gain in Twilio. That was picked out down here, and that's been held. 77% gain. So in MBR, so lots of good gains in this particular scan. Now, so what I thought I would do is take. You have to be a little worried when you do a back test over so many stocks. So like the CBOE weeklies, because you really have to vet each trade in order to be comfortable that that was a trade that you would have taken. And so I'll choose a smaller list. Even the S&P 100 might be a bit too big, but let's just cut it down to 100 from 500 or so. And on the right-hand side, if we do a Control F, we'll look for sim underscore. Now there's an indicator called the 220 EMA upside breakout. Now this is a special entry selector, which will actually generate entry and exit signals both at the same time. So let's just run that. I'm going to choose a year as well. Let's do this. I'm going to choose from 1/1, because I don't want too much data in here, 2019 to 12. So I'm not even going to look at the period that we just looked at, where there were these 100% gains. I'm going to look 12/31, 2020. 2020. There we go. And I'm going to say use this date filter, and then just run this on the S&P 100. All right. So this has now produced my entry signals all the way back from the beginning of 2019. And by the way, you can always just double click on these and see the chart. It will show you where the entry the entry is. And you don't have to see this. It's just I like to verify most of the things that that I'm testing. It makes a lot of difference. Sometimes you assume things are working, and it's always good to actually verify it. So anyway, so in here, right, so this is just one example I clicked on. This was Amazon, and as you can see, the 220 EMA entered here and exited here. And that looks about right. I don't have the indicator for the 20 EMA. I could put that on, but this is going to be quick, so I don't want to bog down with that. So anyway, just an example. You can go through, and as I click on any of these in the entry and exit tab, you'll find all of the entries are highlighted on the chart. That's just what I wanted to show there. Okay. And this was a special script in that it also generated exits for me. I didn't have to put a special exit script in. And now if I go over to trade simulation, I can say, use these scripted entries and exits. I don't now get to choose my entry rules and exit rules. They're already locked in. And I'm now just going to run this simulation. So I'm not really going to do anything else, just going to run the simulation. All right. So now we have a daily equity, and we also have this index. All right. So in 2019, it sort of started at 100. You went up to a value of 23%, and then down to just below 100. So that's the sequence of trades that occurred. So if you wanted to run this through a Monte Carlo simulation, here's what you do. You go pop this out, save it as, put it somewhere that you know. And by the way, I recommend trying this on the NASDAQ 100. So you mentioned NASDAQ 100 before. So let me just show this while we're here. Come over to the entries and exits. And now instead of S&P 100, choose the NASDAQ 100. All right, and that's in here, NASDAQ 100. Just run it on NASDAQ 100 and go back to trade simulation, run this again. All right, a similar looking list, but it does end up at just above average for 2019 with a 6% gain and 1,102 trades in that time period. Maximum number of open trades was 80. All right, so what I would then do is get back to where we were, pop this out, save it as, and then choose NASDAQ Sim, whatever you want to name it, just something you know what this set of trade returns came from, what system. I'll replace the one that's there. And now come over to the templates, come back to the Monte Carlo simulation, and now choose that as your input file. So that's in my trade simulation reports. Choose that file. And so there were a lot of trades in that system. So let's figure out, so 1,102 trades over 1 year period. All right, and that's one particular sequence of those trades happening. So let's say that we'll choose 1,000 trades per, or 1,100 trades per simulation run. And we're going to do 1,000 runs here. So I'll just hit the run on here. And I don't need to look at the charts over here. So I'll hide that. So now we have the Monte Carlo simulation. This is one particular sequence. We can cycle through some of these to see some of these are actually quite nice. And this is an interesting thing to look at, right? Because you can definitely see from here that ordering the trades in one sequence versus another is super important as to the final outcome. All right, in this case, you ended up with an outcome of less than 50% of what you started with. In this case, you ended up with an outcome with more than 200% of what you started with. So what you're trying to do with the Monte Carlo simulation is get the average of that. So let's look at the fixed fractional. This is a roll-up down here of all of those fixed fractional reports. So you can see the 50 level, the 5 level, the 95 level for final equity and max drawdown. So at the one fixed fraction, so you're trading the whole whole account per trade, essentially, you have a 6 final equity at the 50 level, with 5% of the time when you ran a sequence, you ended up with 274 on the plus side, but also 5% on the lower equities, you ended up with 75% loss. And your max drawdowns ranged at the fixed fraction 1 from a mid-range of 80% up to 96% and 61%. So this is if you're trading a 1 fixed fraction here, you've got big drawdowns to contend with, but you have some nice results in final equity. But then you look down through here and you find something that might be more tolerable, and you might say that you can tolerate a 1%. You can tolerate a 12.7% drawdown at the mid-level to try and achieve a 47% gain in your final equity. That's at a fixed fraction of 0.1. So you can go down to those worksheets and take a look at those distributions. And cycle through the various distributions. You can see how the more that you put in per trade, the more the right-hand side, the taller it gets. So, very few cases you end up with this massive gain over here. But there are some where you do end up with that. But you've got to pay attention to the mid-range and the extremes. So anyway, the whole point of that was that at the fixed fraction of 0.1, you can end up with a 47% gain and 12% drawdown. And that's having run those returns through many, many sequences to try and achieve something statistically significant, which is the entire purpose of doing the Monte Carlo distribution. To find out more about how you would actually go about selecting trades and all of the intricacies and ins and outs of doing the Monte Carlo simulation, developing a trading system, that book that I brought up before, I definitely would recommend taking a read of that. Modeling Trading System Performance and Quantitative Technical Analysis. Howard Bandy of Blue Owl Press. For sure. Okay. So anyway, that's the latest template in EdgeRater and gives you an idea of how to run statistically significant trade simulations. I think we've covered all of the questions. Please go ahead and try this out to let me know if you have any comments or questions as you get into trying it. And if you have a sequence of trades that you want to put in and you're having trouble putting that into Excel, send it over to me and I'll put it into Excel for you so you can use that as your input. I'll find that quite easy to do. And you can then see what I've done and try it again yourself. So that's it. Okay. Well, thanks all for coming, and yeah, thanks for attending. Good to see you here, John, and everybody else. Thank you for the questions. Enjoy the rest of your weekends, and we'll see you next time.